Good morning and welcome to the latest Platt Institute webinar. I'm Adam Weinberg, Communications and Outreach Director at the Platt Institute, joined by Sarah Curry, the Policy Director here at the Platt Institute. We are really appreciative of everyone who makes the time to join us on our webinar. Today's webinar is on the federal relief package, the CARES Act, and how it can affect potentially state and local tax policy. We have a wonderful guest today to join us on that, Katherine Loughead, the Senior Policy Analyst of the Tax Foundation. I'm just giving you some remarks here as people roll in and log into the program. Want to let you know the ground rules of today's program. We have Q&A through Zoom throughout the program. You can check it out on the toolbar here on Zoom. Send us your questions. As the program continues, we'll direct your questions to Katherine, our guest. Katherine, thank you so much for joining us this morning. We are really appreciative of the work that the Tax Foundation does. It's an excellent resource. Do you think before you start your presentation, you could tell us a little bit about the Tax Foundation?
Yeah, absolutely. Well, thanks so much, Adam, Sarah, and the Platt Institute for having me today. I'm excited to be with you. My name's Katherine Loughead, so I handle state tax policy at the Tax Foundation. And the Tax Foundation is a nonprofit, nonpartisan tax policy research organization, and we basically advise on state tax policy at the federal, state, and global levels. So we have been really in tune to this discussion about the CARES Act, and I look forward to sharing a lot of that with you here today and what that means for the state of Nebraska. So if you'd like, I can.
Yes, and at 11 o'clock, as a note, we have the tornado sirens that go off all across it. So I heard that, so I'm going to hit my mute button and let you continue your presentation. Go ahead and screen share, Katherine.
Great, thanks. You might have to bear with me a little bit. I still am getting used to Zoom. Can you see that okay?
It looks great.
Great. Okay. Well, I'd like to start today just by talking about, like I said, Nebraska and the Federal CARES Act, but also about state tax policy considerations in general and fiscal policy responses to COVID-19 across the states and specifically in Nebraska. And as Adam mentioned, feel free to ask any questions in real time. I will try to get to those either in real time, if not, then definitely at the end. So I will start by talking about the current economic contraction and how the different types of taxes tend to fare during a recession. And I'll first note that what we're experiencing now is a significant economic contraction that we presume will turn into a severe recession. But until it persists for at least 2 quarters, it's technically most appropriate to refer to it as an economic contraction. So many of you probably saw the BEA announced last Wednesday that GDP fell at a 4.8% annual rate in the first quarter of 2020. And that's especially significant because it wasn't until mid-March that the coronavirus really started impacting our way of life, resulting in business closures and stay-at-home orders. So a decline of 4.8% for the whole quarter, when only about half a month was really impacted, that's truly massive. And some economists are projecting second quarter figures will show GDP contracting by an annual rate of 30% or more, and that's a level we haven't seen since the Great Depression. So in some ways, it can be appropriate to compare the current crisis to other recessions like the Great Recession or even the Great Depression. But of course, we do have to remember that this is first and foremost a public health crisis, so it's way less predictable than most recessions have been. We've never seen anything quite like this, and in large part, that's because businesses are being forced to close and bringing in little or no revenue. It's resulting in a lot of layoffs and furloughs. And of course, we all know that much of the severity of this recession will depend on how quickly we can safely resume some sense of normalcy. So while none of us can control how long the coronavirus will remain a health threat, it's important to think about what role the federal government should play, and also what role state and local governments should play in helping contain the economic fallout. And at this stage, when it comes to economic policy, the main role governments need to play is to implement policies that help keep the supply side of the economy surviving, so that when it is safe to open back up, they will still be in existence, because otherwise that could create much more difficulty in getting into a quick recovery. But if most businesses are able to weather this large-scale shutdown of the economy pretty well, we can recover hopefully pretty quickly. But if a lot of businesses don't survive the crisis, that could become really problematic in getting back up to the level of output we're used to. And that's where people talk about this being either a V-shaped or a U-shaped recession. And we certainly hope it's more of a V-shaped recession. So now these charts show how the demand side of the economy is faring right now. As you'd expect, because of the stay-at-home orders and business closures, US personal consumption is down quite a bit across all categories, like travel, retail, restaurants, and even groceries. They all saw a sharp spike at the end of February, followed by a really steep decline. And we can safely assume that most of this decline is due to the stay-at-home orders and business closures, but certainly some amount of it has to be related just to the people starting to pinch pennies with uncertainty about layoffs and job insecurity and just general uncertainty about what the future holds financially. So again, this sharp spike followed by a steep decline is not at all characteristic of a normal recession, where people we see here now are stocking up and then reducing consumption dramatically. And we certainly hope there will be some stabilization, but we aren't seeing that yet, except in a couple categories like groceries and electronic entertainment, streaming services, things like that. And so this chart shows week by week consumption levels compared to how they looked a year ago. So you can see that as recently as March, consumption was up 2.5 percentage points compared to last year. But by late March, consumption had dropped 30% below where it was this time last year. And in the week since then, it has recovered a bit, but we're still around 20% where we were this time last year, 20% below. So that's a massive overall decline in consumption. So what does this mean for state tax revenue? Typically, it's the sales tax that is one of the most stable sources of revenue during a recession, while corporate and individual income taxes are usually a lot more volatile. And that's because in a typical recession, consumption usually doesn't change all that much. While most of us cut back on some spending during an economic downturn, there's really only so much that most of us can or are willing to cut. So during a typical recession, it's usually the propensity for saving rather than consumption that really changes. So even those with little or no wage income coming in are able to consume supported by savings and governmental assistance during recessions. And you can see on the chart how during the Great Recession, sales tax collections dropped a little bit, but it was really income tax collections and particularly corporate income tax collections that really declined a lot.
And Katherine, we have a quick question. Many of the political subdivisions in Nebraska are facing revenue shortfalls right now, which may or may not be covered by the CARES Act funding based upon the flexibility from the feds. So do you have any idea what impact these tax increases would have on our already really high tax state, especially with farmers and businesses that are currently struggling?
Yeah, that's a really good question. There is, and I'll talk more about that later too, but there is currently a pretty narrow amount of things that the CARES Act funding can be used for, specifically the Coronavirus Relief Fund. And so that we will see the state see a lot of declines in tax collections. Localities, because they rely heavily on property taxes actually, will see more stability than the state overall. So that's good and bad. I know property taxes are burdensome and especially high in Nebraska, but that will be a more stable source of revenue for localities, whereas the state will probably see a lot more declines. So that's a good question, and hopefully a lot of the federal relief will offset some of the expenditures the state would otherwise have to make on direct coronavirus spending, and hopefully that will free up money so the impact isn't quite as bad as it initially sounds.
Thank you. And we had another question, and it doesn't really touch on taxes too much. So if you don't have the information on this, we totally understand. But do you have any idea about how many federal employees have been let go? We've talked a lot about private sector unemployment, but not a lot of discussions have had the public sector. So federal employees, state, I know here in Nebraska, like school districts didn't lay anybody off that, at least a large enough number to get news reportings on. So do you have any idea on that?
I haven't seen those figures. I haven't heard of a lot yet at the federal government. I would imagine that is probably coming, as it did shortly after the Great Recession, when the federal government did have to freeze a lot of spending and hiring and things like that. And a lot of states are starting to do their own spending freezes. Some are slower to the game there. So that's remains to be seen.
Thank you.
Of course. And so basically, we see income taxes declining a lot more quickly than sales taxes here. And I pointed out earlier how grocery spending and electronic entertainment are the categories of consumption that are actually pretty stable right now, or even higher than usual. But the one thing I'd like to point out there is that those are two categories of consumption that Nebraska and most other states don't really benefit from right now, because the sales tax doesn't apply to groceries, and because most states, including Nebraska, have not yet modernized the sales tax base to account for things like streaming services and ebooks and a lot of the app-based delivery services. All those things we're all using a lot of right now. There's not sales tax revenue coming in from that. And so that's something to consider moving forward, that one of the reasons the sales tax is a little more volatile than it was in the past is that the base has really been carved out a lot. So it is worthwhile to start thinking about how broadening that base could help the state weather future recessions a little bit better. But now I'll show briefly on this slide, this is just a different way of looking at it. And this shows that already income tax collections will be pretty volatile, but it's really adjusted gross income that drops even further than people's income overall. And that's because state tax codes and the federal tax code are all pretty progressive when it comes to the income tax portion of that code. And so things like standard deductions, personal exemptions, graduated income tax rates, refundable credits, those will all result in the first tens of thousands of dollars of people's income being taxed a lot less than the top tens or even hundreds of $1,000 or more in income. And so when people's incomes decline, more people will be eligible for some of those refundable credits. Those top rates won't be kicking in as much. And so that's part of the reason why AGI declines a lot more than even people's income overall. So just something I wanted to point out there. Next, I'd like to talk briefly about how Nebraska stands financially going into this crisis, because as of the beginning of 2020, Nebraska actually had $510 million in its budget stabilization fund, which is enough to cover about 11% of the state's general fund expenditures for a year. And compared to other states, Nebraska is actually doing pretty well there. It's the 13th best funded budget stabilization fund in the country when looking at the balance as a percent of general fund expenditures. So that's definitely an advantage Nebraska has going into this crisis, but there's a strong chance that that will be completely wiped out by the time this is over. And so while a lot of states have so far been predicting between 5 to 10% in tax collection reductions overall, those are probably way too optimistic. Right now, a lot of economists are starting to project that states will see revenue shortfalls that are actually significantly worse than those seen during the Great Recession. The CBO has projected state budget shortfalls will reach $650 billion over the next 3 years alone. And that's compared to about $690 billion in budget gaps states had to cover over the course of 5 years during and after the Great Recession. So all this to say, it would be much better in the long run for states to prepare for the worst now and to try to spend the rest of the year living in denial and cutting spending later because there's a very real chance that would have to result in a lot of pretty bad tax increases if spending isn't cut now. So that kind of gets back to that question about freezing spending and the importance of some of that. I'll also note that earlier this year, it was projected Nebraska would have a budget surplus for the current biennium. That's expected to be wiped out. And Nebraska is in a unique situation though, because you are in the middle of a 2-year budget cycle. So you won't be looking at your next budget until you go into session next year. But it would be pretty wise to consider either when you reconvene again this year, if that's going to happen, or in a special session, looking at potential spending freezes. And I think I see another question coming in about whether you use the words penny pinching or savings. Are not these activities reducing consumption, savings, and deleveraging and lowering debt exactly what smart economists say is exactly what American citizens, businesses, and even our governments need? Sure, less consumption reduces GDP, but is it not still the only solution for our economy? Yep, I would definitely say, well, if I understand the question correctly, I think spending reductions are the most important thing that needs to happen now in order to be realistic about the budget shortfalls the state will be experiencing soon. But really, we want to do whatever we can to get our economy back up and running safely so that budget shortfalls might not have to be as bad as we currently see. So kind of moving on, I will say that, so it could make a lot of sense for the state to consider budget cuts yet this year in order to prevent more drastic spending reductions and tax cuts in future years. And then I'll also comment just on how the state's unemployment compensation system is doing right now. Like every other state, Nebraska is experiencing unprecedented strain on its unemployment trust fund. The CBO has said the first quarter unemployment rate was 4%, and it's expected to reach 15% during the second and third quarters of 2020. And as of the week of April 25th, over 83,500 initial and continuing unemployment claims have been made in Nebraska. That's a very high number for the state. For the sake of comparison, as recently as March 14th, Nebraska was paying out less than 6,000 claims. So the state has 14 times as many claims to deal with now as it did a month and a half ago. And when looking at these claims as a percentage of the civilian labor force, that's about 8% of Nebraska's labor force that has applied for or is already receiving benefits. And that's a little lower because nationally that's at 13%. But to put this all in perspective, during the height of the Great Recession, the peak was 4.8% nationally that had applied for or receiving benefits at any one time. And right before this crisis, it was only 1.4% of the population that had applied for or was receiving benefits. And we have a helpful tool on our website, if you haven't seen that yet, that shows state-by-state unemployment trust fund balances. And by our current calculations, Nebraska has less than 14 weeks left in its unemployment trust fund before it will have to start borrowing from the federal government. And that's assuming no new claims. So in reality, the state probably has a lot less time to start borrowing before it will need to start borrowing from the federal government to continue making payments. And how that works is that Nebraska will want to take out a Title 12 advance, which is a loan from the federal government. The first 2 years, or the first year, can be repaid interest-free, but if the state doesn't pay back the loan after 2 years, in-state businesses will face higher federal unemployment tax rates to compensate for the state being in arrears. So historically, a lot of states have tried to avoid interest payments by doing whatever they can to pay back the federal loan within that amount of time, even if that means issuing bonds of their own. And so now I'll talk more about what the federal aid package, the CARES Act, means for the state of Nebraska. So as most of you are probably aware, the Coronavirus Aid, Relief, and Economic Security Act, or the CARES Act, was signed into law March 27th. And this law built upon two prior rounds of federal government support in the wake of this crisis and the associated economic fallout. And it includes a variety of relief for state and local governments, businesses, and individuals. So I'll go over the major ones quickly here. The Exchange Stabilization Fund, that's $454 billion in loans to state governments, businesses, and in some cases, local governments. A lot of this has already been paid out, though. A lot of states have already applied for this. It's a loan administered by the Treasury Department. So we'll see if things like that get re-upped in any future legislation. There's also the emergency supplemental funding. That's $274 billion in block grants that every state receives every year in general support, but Congress has provided a booster. So every state is getting more than it usually does. And so that includes $45 billion in disaster relief fund money, because we're under a nationally declared disaster, and $30 billion in education stabilization fund money. And I point this out because this funding is actually very flexible. So while education costs are fixed in a lot of ways, the state is experiencing a certain amount of reduced spending on education right now, with a lot of it being remote. So a couple of states have actually reduced their general fund allocation for education in order to use the education stabilization fund money for that purpose, and then they are repurposing the money they'd normally spend on that for other general fund expenditures. So that's something to consider. The emergency supplemental funding also includes $5 billion in additional community development block grant money for individuals, homeless assistance grants, economic development grants, transit assistance, things like that. It also automatically triggered $50 billion in Stafford Act funding, and that's because the president declared a national emergency on March 13th. And then finally, the Coronavirus Relief Fund. That's the CARES Act provision that's gotten a lot of attention lately, and that's $150 billion in aid to states, territories, and tribal lands. It's largely allocated by population, with $3 billion going to territories in DC, $8 billion going to tribal governments, and the remaining $139 billion going to states. And the allocations are largely based on population, except that there is a minimum allocation of $1.25 billion per state, even if that state's population would otherwise indicate a lesser amount. And Nebraska is one of those states that by population would have received less, but that guaranteed minimum $1.25 billion is helping out the state right now. And so how this works is it looks pretty complicated in some states like Ohio, as you can see from that flow chart on the screen. But in Nebraska, it's actually pretty simple. Essentially how it works is every state receives its allocation based on overall state population. In states that have counties with populations of 500,000 or more, each of those counties will receive some of that overall allocation directly. And so in Nebraska, Douglas County is the only county that has a population of 500,000 or more, and about 30% of Nebraskans live in Douglas County. So that means Douglas County gets 45% of the 30% of the 1.25 billion. So Douglas County is getting $166 million, and the state is getting the other $1 billion in coronavirus relief fund money. Now, my assessment is that that's pretty generous. Nationwide, states will receive an average of $458 per person in CRF money alone, but in Nebraska, that amounts to about $646 per person just in CRF money. And so that doesn't count the other types of aid, federal aid I just mentioned. So it's a pretty generous fund, but because the money is limited in how it can be spent, it can be, and it might be a bit difficult for Nebraska to find ways to spend this, depending on how bad the coronavirus gets in your state and how long the crisis lasts overall. But the intent of this money was that states use it that it be used to reimburse states for direct coronavirus related expenditures that are incurred this year. So unfortunately, the statute itself and the guidance that was released by the Treasury Department on April 22nd, they're both a bit murky, but our reading of it is that this can't be used to fill budget shortfalls. It has to be used on direct coronavirus related expenditures. So it has to respond directly to the pandemic It has to be on expenses incurred between March and December of this year. It has to be used for spending that was not already factored into any state budget that was adopted before March 27th. So that means Nebraska, if it was budgeted for in your current FY 2020 through 2021 budget, that expenditure is not eligible for reimbursement under the CRF. So this is basically preventing states from saying all funding that was previously allocated to hospitals is now considered coronavirus response funding. That's not Congress's intent here. However, the CRF can be used to pay the salaries of public sector employees if their primary role is responding to the crisis. So that includes law enforcement, public health and safety officials, certain social workers, and the money can also be used to provide economic relief to individuals and businesses impacted by the pandemic and the resulting economic crisis. So while it presumably can't be used to provide general tax relief, there is room for some targeted relief to businesses that have experienced closures, and the guidance provides some examples of that. But I will note that the $83.6 million the state has already allocated in March, the unicameral passed that. It was signed into law right before the CARES Act, LB 1198. That does appear to be eligible for reimbursement. So that is good news. But I say all this because states like New York will have no problem spending the CRF money, but states like Nebraska very well could. But if that weren't challenging enough to figure out, it's important to be aware that Congress may very well consider additional legislation in the coming weeks that could repurpose how the CRF money is used, because a lot of states like Nebraska have talked about how it might be difficult to spend on direct expenditures, but that it could be valuable and could be used in other ways to provide economic relief. So the National Conference of State Legislatures has actually requested $300 billion in additional flexible federal aid to states. The National Governors Association has requested $500 billion more. And that request has actually been turned into a bill introduced by Senators Cassidy of Louisiana and Menendez of New Jersey. It's a bipartisan bill that would allocate $500 billion in new federal aid to states based on population, number of coronavirus cases, and economic conditions in the state, like revenue shortfalls. Now, there has been a lot of pushback on that last idea, as there's concern about whether this just becomes a bailout for states to use the money on things that have nothing to do with the pandemic, like structurally unsound pension systems in Illinois, New Jersey, and Kentucky. So that's on the table. Speaker Pelosi has actually proposed a $1 trillion package for state and local bailouts, essentially. And for perspective, $1 trillion is the entirety of state, but not local, tax collections for an entire year. And that's more than double the 5-year revenue losses projected by Moody's. So it's really difficult to see that as being anything other than a way to let states off the hook if they have been fiscally irresponsible in the past. And we at the Tax Foundation have concerns about that because states could very well use that bailout to increase spending and create all these new programs that they would have to raise taxes to cover later. So this whole debate is pretty controversial. It's unclear what's going to be done, but additional funding is likely, and potential reprogramming of the CRF money is pretty likely. And so I don't know if this is a good time, if there's any other questions that have come in. Otherwise, I can talk about the relief rebate in the CARES Act.
Yeah, we had one question. What are the terms of the exchange stabilization fund? And then, how does that relate to Nebraska, or has Nebraska applied for that?
I don't know for sure if Nebraska has applied for that. Basically, that is basically just, I wish I knew more about the exact terms there. I know it is pretty broad, and I know most of that money has already been spent. So I could try to get back to you on whether Nebraska has applied for that. Not exactly certain.
No, that's fine. And then we have another question. Just curious, what is the population threshold? So, the states with lower populations received $1.25 billion. Do you remember what that population threshold was when they started getting more?
Fortunately, I'm not aware of that either. So I'm on the state team at the Tax Foundation, so I was not following the federal debate all that closely. I've not, because it went through so many iterations. This bill had so many different drafts, but the final bill I know did result in this. And so I can, again, try to get you that information. I don't know right offhand though.
Thanks. And then there's one other question. This kind of goes back to your discussion on unemployment. So just to wrap that up, since some people are starting to go back to work now because Nebraska has lowered some of the requirements, will some of those unemployment claims stop? And then will that help the state, I guess, lengthen that time period you were talking about of how long they can go?
So that's all. Can you repeat that question again? I'm sorry.
So because Nebraska is starting to open back up, so salons can open and restaurants can now open at a limited capacity. Before they were closed completely, except for, carry out. So because those people are now getting back to work, is that going to put less pressure on the state's unemployment fund? And so you said we only had about 14 weeks, but because, the pandemic's lasting longer, it might put more pressure on it. But as we allow some of these people to get back into the workforce, will it put less pressure on the state's unemployment insurance?
It certainly will. Yep. So if people are able to go back to work or able to get back up to, even if it's a slightly reduced level of work, there is some amount of compensation for underemployment as well as complete unemployment. But as people are able to get back into the workforce incrementally, that will help reduce strain on the system and help reduce some of those benefits that are being paid out and make them less necessary, because people do have to certify on a weekly basis that they are unemployed and still unemployed. And so hopefully we'll see a lot of people get back into employment sooner rather than later. But there's some concern that, again, if a lot of businesses aren't able to weather this crisis and they have to close down permanently, that'd be the worst possible scenario. But we want to, again, do whatever we can to help these businesses survive so that they can quickly hire back their employees or as soon as it's safe to do so.
Thanks.
So now I'll talk briefly about the relief rebate and the CARES Act, because a lot of people ask about this. Basically, this is the check that a lot of people got direct deposited or that should be coming soon if it hasn't been already. It's $1,200 for single filers, double that for joint filers. It's also $500 per child age 16 or under, and there's no limit on the number of children. So that's kind of an interesting departure from kind of some other past federal legislation. But it starts to phase out for single filers between $75,000 and $99,000, and for joint filers between $150,000 and $198,000. And this is all based on taxpayers' 2019 tax return information. And of course, deadlines have been extended. So if taxpayers have not filed their 2019 returns yet, it's based on their 2018 returns. This should occur automatically for most people. And I will note that if you get more of a rebate now based on your 2020 situation than you would have in 2018 or 2019, say you had another child or you earned less income this year, something like that, you can get that difference when you file your 2020 return next spring. So some people will be getting refunds there. The law also does say that if you would receive less of a rebate now than you would have in 2018 or 2019 because you make more money or things like that, you won't get penalized for that and you will be able to keep that difference. So there are, of course, a lot of other changes in the CARES Act designed to help individuals and businesses. I can't get into all of them now, but some things to be aware of. There's a charitable contributions credit. That's enhanced beyond what it normally is. There's a waiver of the 10% early withdrawal penalty on IRA distributions for certain taxpayers impacted by coronavirus. There's an exclusion from taxable income for certain employer payments of student loans on behalf of employees. There's a federal employee retention credit, paid family and sick leave. So hopefully that gives you a broad overview of what's in the CARES Act and the most important provisions to be aware of. But now I'll talk about how the CARES Act's tax provisions interact with state tax codes. And this is important because every state, to at least some degree, uses the Internal Revenue Code as the starting point for its own tax system. So anytime the federal government changes federal tax law, states conform automatically to some of those provisions, or some states can choose to conform or decouple from those provisions as well. So states will have to make some of those decisions moving forward on whether they want to reflect the same tax changes in the federal tax code on in their own tax codes. So the first area in which conformity will play a role is in the treatment of interest payments on business debt. And the backstory here is that when the Tax Cuts and Jobs Act of 2017 was enacted, a number of base broadening trade-offs were made to help pay for some of the more pro-growth tax reforms. And one of those trade-offs was that the law limited the amount of interest businesses can deduct as a business expense when calculating their taxable income. So under an ideal tax code, all business expenses, including interest payments on debt, would be deducted from gross revenue when arriving at taxable income. But by definition, net income taxes are taxes on profits, not on gross receipts. So that's the reasoning for that there. And that's why the federal tax code and states allow businesses to deduct some of their interest payments as business expenses. But currently we're in a situation where it would cost money, of course, to offer total deductibility. So the Tax Cuts and Jobs Act limited interest deductibility to 30% of earnings before interest, taxes, debt, and amortization, or EBITDA. So that's what the Tax Cuts and Jobs Act did, but the CARES Act lifted that cap partially to 50%. And that's because a lot of businesses will need to go into debt in order to survive. So there's concern that keeping that 30% cap in place would have been pretty harmful to a lot of businesses. And so the 50% cap is in place for tax years 2019 and 2020, and Nebraska does conform to this provision automatically on a rolling basis. So businesses will get that same benefit under the state tax code. It is worth being aware that this will reduce corporate income tax revenue by about 4 to 5%. But again, we think this is good tax policy as it will help businesses that need to go into debt in order to survive. And then the second conformity provision I'd like to mention is having to do with how business net operating losses are treated for income tax purposes. Because when you think about it, taxing business income on an annual basis is actually pretty arbitrary, as businesses can experience large profits in one year, but post substantial losses the next. So to help make up for this, the federal government and states allow businesses to deduct current losses against future profits, and that's known as a net operating loss carry forward. Currently, Nebraska allows NOL carry forwards of up to 20 years, and that's a pretty good spot to be in, but the state does not offer any NOL carrybacks. And both the federal government and the state used to offer NOL carrybacks, and that was another base broadening provision in the Tax Cuts and Jobs Act where carrybacks were eliminated. There used to be 2 years there, but the CARES Act has modified that and said that businesses will be allowed to claim 5 years worth of past profits, or 5 years of carrybacks for any losses incurred in 2018, 2019, or 2020. So a lot of businesses will really benefit from this provision, as it will basically enable them to get a refund now if they're experiencing losses now or have in the past couple of years against past income taxes they've paid. Currently, Nebraska does not conform to this provision, so Nebraska will not allow carrybacks. So that is certainly something to consider in any conformity legislation the state might be able to pass either later this year or definitely hopefully by next year. One other thing I'd like to mention here is qualified improvement property. This is pretty important. So the backstory here is that one of the most pro-growth provisions in the Tax Cuts and Jobs Act was that it offers temporary full expensing of short-lived assets. So businesses that invest in machinery and equipment can fully deduct those costs in the year they're incurred instead of deducting those expenses incrementally over the life of the asset, which could be years or even decades. But unfortunately, there was a clerical error in the Tax Cuts and Jobs Act that resulted in qualified improvement property being excluded from that full expensing eligibility. So this impacted a lot of restaurants, movie theaters, a lot of businesses that rely a lot on interior remodeling and improvements. They were actually made worse off accidentally by the tax reform law. So over the past couple of years, there's been a lot of partisan debate about trying to get that fixed. And the CARES Act did finally make that fix. So they will get to benefit from that temporary full expensing. And Nebraska does automatically conform to that provision. So that is good news there. And then finally, loan forgiveness under the Paycheck Protection Program. The Paycheck Protection Program is the CARES Act provision that allows small businesses to receive loans based on their desire to keep their employees employed during the pandemic. So these loans can be used for making payroll and also for covering rent, mortgage, utility expenses. So under the Paycheck Protection Program, if a business is able to continue maintaining payroll, that loan can be forgiven. But under normal federal income tax law, a forgiven loan or the discharge of indebtedness is a taxable event. So that forgiven loan is considered taxable income. But the CARES Act said that would defeat the purpose of offering these particular loans if that loan forgiveness is taxed. So a provision in the CARES Act does exempt PPP loans from income taxes, but that provision was actually not written directly to the tax code. It instead amends the definition of gross income from outside the IRC. So it's unclear at this point whether states conforming to the federal definition of gross income on a rolling basis will automatically bring in this exemption from income taxation. If I had to guess, I would say Nebraska probably does offer this relief, since Nebraska conforms on a rolling basis and uses federal taxable income as its corporate income tax starting point. And states do tend to bring in guidance from the year to which they're conformed, but this isn't guaranteed. So there could be room for states to argue that even though the provision modifies gross income, because the state only conforms to the definition of gross income and not to the particular provision that was amended, it doesn't get carried through. So there's a lot of uncertainty here, and it would be best for all states to clarify what their intended purpose is and whether they want PPP loan forgiveness to be taxable or not. So that is something to consider also for whenever the state goes back into session. And now finally, I'll close by talking generally about other state fiscal policy responses to COVID-19. Some of these Nebraska's already taken care of. Some are things the state should still consider. As I mentioned earlier, many states have already appropriated funding for COVID-19 related expenses, like Nebraska did in March. And the good news is these should be reimbursable on using the CRF money. In addition, most states and the federal government have, of course, extended their income tax filing and payment deadlines, and Nebraska does follow the July 15th federal deadline there. This is good policy, but it's actually really challenging for a lot of states because every state except Vermont has some sort of balanced budget requirement. And so most will have to close out this current fiscal year in a balanced budget by the end of June. So in Nebraska, the budget has to be balanced when it's introduced, passed, and signed, but not when it's executed. So Nebraska will presumably have a little more flexibility than other states in how quickly it has to address the shortfalls from the delay of the tax deadlines. But a lot of states are in a situation where before the end of June, they're having to shift payments into the next fiscal year, use their rainy day fund money, freeze spending, and things like that. And like I said before, a lot of states have already frozen spending for the current fiscal year. Another thing to keep in mind is that the federal government has expanded unemployment benefits. And so while we talked about earlier where a lot of that is federally covered, because the state is offering a huge amount of new, or just seeing a whole lot of new people applying for the benefits, this will impact the state. And so it's basically important to keep in mind that unemployment insurance taxes at the state level will eventually rise if nothing changes. So basically how the UI tax system works is that because it's a social insurance program, the businesses that contribute most to layoffs are the ones that have the highest experience ratings, and that determines how high of UI taxes they have to pay to the state. And so if the state and the federal government are requiring businesses to close and they're forced to lay off workers through no fault of their own, their experience ratings will soon increase a lot if the state doesn't do anything to freeze those. And so we're recommending that states do freeze those experience ratings so that businesses aren't faced with these astronomical tax increases right at a time when they most can't afford to pay them. And so while we acknowledge that, yes, eventually unemployment trust funds will need to be built back up, the time right now, that's not the time for it right now, and that we really need to, again, be ensuring that we're not doing anything to unduly harm businesses that are being put in these positions. And so I think that's about, I guess the one quick final thing I'd like to cover has to do with adjustments to telework related withholding and nexus provisions, because a lot of people are working remotely right now. And I know a lot of people in DC are working remotely in all kinds of states across the country. Presumably a lot of people are in Nebraska to ride out this with their families. And so the problem here is that this could trigger both income tax withholding requirements for those people's employers, and it could also require employees to file taxes in a whole bunch of other states that they're not used to filing in. And the reality is the state doesn't really want people to file returns in these states if they're not going to owe anything in income taxes. But this could be a pretty burdensome requirement if all of a sudden businesses are having to withhold taxes in states. And so it's really only businesses and individuals that are really honest or in tune with tax law that would be doing this. So it would make sense for states to say that during this crisis, people who are temporary teleworking just due to COVID-19, that doesn't trigger those withholding requirements. And then there's also, this is less of a concern for Nebraska, but for other states who use three-factor apportionment for their corporate income taxes, there could be situations where people working remotely in a state could trigger corporate income tax liability for their employer just by being one person on payroll who's in that state at the time. And so a lot of states, even New Jersey, are being leaders on this and are going ahead and waiving those requirements. Because Nebraska uses single sales factor apportionment, you won't be bringing in a ton of new people under your corporate income tax. But I definitely wanted to point that out because that could impact Nebraska businesses if states as a whole don't start to waive those requirements. And so that covers the highlights of what I wanted to mention today. And I know I went over a lot, but I'd be happy to take any questions.
Well, thank you so much, Katherine. And just for a programming note, I sent it out in the chat window, but folks, if you'd like to catch the recording of today's program, look back for research on a lot of the great topics that Katherine brought up, or you'd like the slide deck that Katherine is using, that'll be available later at plattinstitute.org/podcasts on our podcast page at plattinstitute.org. And the link is actually there in the chat window. If you want to bookmark that, you can check it. As we go through these programs and do more webinars, we're going to continue to update those and bring those out there. Now we've got some time for questions, so we'd be happy to entertain those in the Q&A section. I know we received some questions also previously by email. Sarah, do you want to offer some of the questions that viewers brought in earlier?
Yeah, so the Nebraska legislature, before this whole thing happened, sales tax base expansion. It was a really big conversation, a lot of bills last year and this year on it. So with this new pandemic and with this new situation, when do you think would be an appropriate time for Nebraska to broaden its sales tax base if the legislature decides to move forward with that policy decision?
Yeah, that's a really good question. And while Nebraska and every other state's immediate response to the revenue shortfalls should be to reduce spending, if the state eventually finds itself in the position of needing to generate new revenue to make up for the current shortfalls, policymakers should consider broadening the sales tax before thinking about increasing any tax rates. It's generally just good policy because broadening the sales tax base would make the tax code more transparent, more neutral and stable, and the state would be able to benefit from that new revenue moving forward. And so generally we recommend that that's a good way to pay for per growth tax reductions. So if the state does find itself in a position where it is doing better than expected, that base broadening could be used to offer to do some of the conformity work that I talked about earlier. But if the state really finds itself needing new revenue, sales tax base broadening would be a good way to do it instead of raising rates.
I don't mean to interject some of the politics into the policy aspect of it, Katherine, but we know, of course, that a lot of people have discussed why broadening the sales tax base, and we support it, is a good policy move for states, especially if they want to do tax reforms without raising tax rates. But the political reality that's setting in is the service sector was so heavily hit by this economic contraction that what was complicated may seem to a lot of people almost impossible or unthinkable. So what are some of the pieces of advice you'd have for policymakers who are going to approach a question like that, and people are going to say, well, my business, a salon or other kind of service-oriented business, was hit so bad, and now you're going to be adding this new obligation for tax collection that I don't have, or that I didn't have before?
Yeah, that's a good question. And the politics is always really difficult on this. It is challenging. The reality is sales taxes weren't built for the 21st century economy. And so, the service sector was largely excluded kind of as a historic accident from the sales tax. But that's not what consumption taxes are designed to do. And so, while it'd be great and it'd be ideal to not raise taxes on businesses or individuals during this time, if the state does start to have conversations about raising taxes, which in the Great Recession, that didn't happen as much immediately, but it did happen a few years later, like starting in, I think, 2011, 2012. That's when states started raising a lot of taxes, and a lot of those taxes were harmful taxes on income. A lot of them were regressive taxes on basically excise taxes on whatever narrow-based targeted tax they could come up with, or increased fees and things like that. So it would be much better for the state as a whole to think about kind of biting the bullet in the sense and doing it this once so that the sales tax looks better for the future. I think now would be not now, but if the state needs to raise taxes, this would be as good a time as any to get that sales tax base modernized so it encompasses all final consumer goods and services while leaving business inputs out. That's really important. Business income or business inputs shouldn't be subject to a consumption tax because that leads to a lot of tax pyramiding, but final consumption certainly should.
Thanks. We had another question come in about the CARES relief fund, or the CARES relief money that was sent down from the federal government. And we talked a lot about the Tax Cuts and Jobs Acts and the changes to the tax conformity. Can that money be used if the state of Nebraska wants to conform to those changes to help businesses with their liquidity provisions and that type of thing?
Right now, we have to assume the answer is no. Again, the statute and the guidance were pretty murky on that, but no, right now that can't be used for tax relief. However, there is a chance that that additional federal legislation could free up some of that money to be used for conformity, and that there's a very good argument for that, because the intent of the CARES Act was to say that if states are spending this money that they didn't expect to spend because of the pandemic, they should get some federal support in that. And the CARES Act is only happening because of the pandemic. And so conformity to the CARES Act is only happening because of the pandemic. So I think there's a very good argument for some of that money being able to be reprogrammed and used for conformity, as that will provide economic relief that the federal government thought was a good idea for the federal government to offer to businesses. And so allowing states to use that money to offer that same relief to businesses would make a lot of sense.
So on that, the unemployment money that's come from the federal government, obviously the state is paying unemployment, and then also we have this additional $600. Is that money taxable? Is the state going to see income tax revenues from that state portion, then also from that $600 portion?
You know, that's a good question. That's a little outside of my area of expertise. I'm not positive there, unfortunately.
My understanding would be that the unemployment benefits would be taxable, but that the relief payments that people are receiving, the economic impact payments they're receiving from the CARES Act, the $1,200 or $2,400 or whatever, depending on your family and tax filing situation, that those are not taxable. Would that be correct?
I believe that is correct. I'd have to verify that though.
Speaking of intent of the CARES Act, Sarah, wasn't there a question related to businesses like agriculture? We have some time to take that on.
Yeah, Katherine, do you have any insight or discussion on agriculture? I know that you deal with state taxes in whole, and agriculture is a really niche area, but a lot of our viewers and citizens are directly touched by the agriculture industry here in Nebraska. So if you have any information on that, we would love to hear about it.
Yeah, absolutely. And, you know, that's a very real concern about how farmers and other people will be able to continue making property tax payments during this time. Nebraska is in a unique position where 92% of the total land in the state is farmers. And so that's more than any other state where so much of the land is ag land. And so by default, because every state relies so heavily on property taxes as a local source of revenue, that's really what localities have to rely on. And if those property taxes aren't coming in, the localities won't be able to continue sustaining those, law enforcement, EMS, utility services, things like that. So moving forward, hopefully some of the relief that is being provided elsewhere will help with some of that. And hopefully the state will have some amount of flexibility to be able to recognize the importance of providing tax relief to the taxpayers in Nebraska. I know property taxes have been a concern for a long time, and I think now more than ever it highlights the fact that spending is what really needs to be examined at all levels of government, but now is an especially good time to look at that.
Katherine, you had expressed some optimism that Congress would act on flexibility in the CARES Act for state and local governments so that they wouldn't have to be locked into conducting new spending in order to receive these funds, that they would be able to meet some of their current challenges because they are going to have such significant loss in revenue. Do you have any update from what you're seeing from where you sit closer to the nation's capital on where that conversation is?
It sounds like there is going to be something. I think that's a given. I know most of those conversations are happening behind the scenes. I haven't been privy to most of that, but we've seen pretty big proposals from some pretty important groups and from the Speaker of the House, from bipartisan senators. So I think we're still seeing how that debate is playing out, and it's controversial. I mean, states that have managed their budgets well want to be rewarded for that. And yes, they want some help because this is so unprecedented, and the federal government is able to deficit spend while states can't. So there is a good argument for federal aid, but this shouldn't be a bailout for states that have been managing their finances well, because that just becomes more and more unsustainable down the road.
Well, thank you so much, Katherine, for being with us today. I really appreciated all of your expertise and your time, and the Tax Foundation is such a great resource and partner. We're going to look forward to all of the work that you have to share in the months and years ahead. We are looking forward to the continuing effort to make our states and our local communities whole. I want to thank you for everything you're providing on your end.
Absolutely. Thanks so much for having me.
Absolutely. And Sarah, thanks for helping me with today's program. Folks, this is just one of 3 webinars we're hosting in the month of May. Each week, Wednesday at 11 Central, 10 Mountain, we're going to be hosting Platt Institute webinars that registration is now open for. You can check them out at plattinstitute.org/webinar. Our next week's program on May 13th, we're going to have Jay Rempe, the senior economist of the Nebraska Farm Bureau, along with Tom Sell, who was actually the Deputy Chief of Staff for the U.S. House Ag Committee. And so both of these gentlemen are going to talk to us about the impact on agriculture in the COVID-19 environment. And then the week after that, on the 20th, hosting duties are going to be taken over. You won't be seeing Sarah and myself. You'll be seeing Laura Ebke and Nicole Fox. They'll be hosting a webinar on post-pandemic licensing and regulatory reform with Dr. Ed Timmons of the Center for a Study of Occupational Regulation and Dr. Matt Mitchell from the Mercatus Center. So they're going to be talking about the job creation landscape here now that we are starting to talk about how do we reopen safely, how do we create economic opportunities when so many people are hurting. So please join us for that Wednesday morning, May 20th. Thank you for your time. We're looking forward to continuing this conversation, and if we can be a resource in any way, we'll look forward to doing that and look forward to having this recording soon on plattinstitute.org. Thanks, everyone, and have a great day.